Hey, how's it going today?
Hey, Games, how's things?
Good. Good. Happy Wednesday, everybody.
Yeah, absolutely. Just selling. It's all you want.
Yeah. Yeah. Isn't it funny how, if only, only a couple of weeks make a big difference between sentiment. It's one of those things that I try to pay attention to. And, usually you can tell if there's, like chats, like some of the chats I follow, like on TradingView, that kind of thing. You can just see there's, bears get beat up left and right. Uh, you know, memes about bulls and stuff. There's all this sort of sentiment that's pointing towards overbought, I guess you could say.
Yeah, yeah. I hope it stays like this.
Yeah, so basically, there's some weird things going on. With price action here. We'll just wait another minute here for anybody else to join. But I kind of wanted to talk through just like what I'm seeing, and hopefully kind of you can put two and two together with some of the comments that I've been making in like discussion or the main channel here, and then also talk about some hedging. Like what might be some good levels, some of the reasoning behind that, and also leave some time for questions. Anybody have anything that we should address that I can write down here? Any burning questions? Okay, cool. And if I'm talking too much, somebody has to stop me. All right, cool. All right, guys. Well, let's first I wanted to just kind of show my screen here. So yeah, I apologize. I made a mistake on the comments I made earlier today about non-farm payrolls. Pretty much, I had this thing filtered, and saw it come up, and I didn't put two and two together that, hey, we already saw May. Nobody cares about May, but that's what happens when you only get one cup of coffee out of me before I do that. So the real piece I wanted to get across here is the unemployment change, or sorry, the employment change. So, I mean, we'll get unemployment data on Friday and, non-farm payrolls or whatever, but I was kind of thinking that it's probably not going to be as good as it was before. Just because, if we're looking at, I mean, this is still like a quarterly sort of view, and, it has dipped a pretty decent amount. There's some commentary I've been reading today about, there's, I guess what you could say, like there's, people saying, oh, these numbers don't add up, or it's not realistic, or, whatever. I don't know how true that is. I haven't really heard much about the data reporting. I know that there's some, there was some concerns with employment reporting back, before the election, but I don't think anything really came of it. It was just like, downward revisions for things that were overcounted. So I think we're kind of seeing, just a general slowdown, right? I mean, you can see from, you can kind of see from back, just a couple of months that, downward trend, right? But other than that, you think it's kind of weird that we saw some buying today. Well, I don't know, because typically when you're looking at some of these, so I'll just I'll start with the Nasdaq here. Sorry, I gotta let in 1 second, guys. Sorry about that. Got a very annoying dog that needs to be let in, or else she's going to scratch at the door and annoy us all to death. Probably just me, but all right. So what we've been kind of seeing over the last couple of days, I think this is a pretty, I guess, a pretty interesting sort of setup. There's really kind of like two chart patterns here that I was going to show. This is sort of like the main view, where if you zoom out, we've got this long-term ascending wedge here. And what's important about this is that once this like lower trend line is broken, that's a signal of weakness. So even though we have seen a decent amount of buying, there's always typically like a retracement wave, or I guess put it like this. There's always like a signal. It's kind of like the bat signal, where it's like, hey guys, there's general weakness out there. If you have trapped longs, if you're like a large institution and you have billions of dollars or hundreds of millions worth of long positioning that you had bought up over time here, like in the trend up, it's sort of like that signal to go back and get it, if that makes sense. And excuse me, sorry about that, guys. Been having a little bit of a throat issue today. But basically what we're kind of looking for is, where does this retracement stop? And if it does roll over here, like what kind of patterns and things does it confirm or invalidate? And so what I look for in the mornings, so before I, do my morning pulse and stuff like that, I do review a decent amount of data and, kind of look at the charts and look at some of the volume and things that have happened like overnight. And that kind of like informs the analysis, I guess you could say. And, what I've been looking at over the last couple of days has been really just a handful of days of weird price action. And typically when you see this weird sort of price action, quote unquote weird, is when you can see these like topping episodes, or because topping is always a process. But I guess the longer term headline here is that this this trend line here has been broken, and on some decent volume, right? I mean, if we go to the daily view here, you can kind of see that this was the day after we had the last webinar. But you could kind of see a little bit of it here with the hammer we had the day before. But we had this big spike up that was sold down, and now we're kind of seeing this like march up again. But you're starting to see this sort of heavy volume that was essentially designed as a retrace. Kind of like I mentioned before, where it's like all right, well, the trend kind of slowing down, things are getting a little bit weaker, so maybe we need to juice the market and go get our longs back. I mean, if you have a bottomless pit of money, I guess you can do that, but we can't do that. So it's just it's important for us to kind of take a step back and kind of just think through what the next steps might be, or like what are the most highest probability scenarios. So I think I had mentioned that I think overall that this whole structure here from the Nasdaq, and really like the S&P, the Dow, small caps are a little different, but you can kind of see this sort of really long-term ascending wedge here. And as it looks right now, it kind of looks like it's just a series of ABCs. And I mentioned that there was a pattern. It's called like just a flat, where typically here you'll see like 3 counts. So 2 3 counts, it's like a 3 3 and a 5. So you see 2 ABCs, and then you would see like a 5 wave down. So this would be in just a typical flat sort of correction. There isn't anything magical about this. There isn't, it really does though. So like longer term, I guess you could say we might have a little bit more chop over the next maybe year or two if we don't see just a protracted decline. But if we do have that sort of market stuck in neutral, even if we do see some sort of move like this, which would sort of complete this this sort of flat pattern, this is a typical wave 4 kind of corrective pattern. And if we zoom out to the larger market, you can see that it's really not not too crazy. We did violate the top before here. So from a wave theory perspective, it kind of invalidates that this is an impulsive sort of move. So we're just going to kind of take it one day at a time. But for the overall analysis, I'm still thinking that it resembles a flat. I think Fred Frog was talking about that too, in the Inner Circle channel. But this is just like one kind of inflection point. And typically, from like a measurement perspective, you see, like this, you usually see about a 90 to 95% sort of retracement in a flat. You can see them, pivot and, back down further below, but, usually in a strong uptrend, as we've been in the last couple of years, this doesn't really surprise me. Plus also we mentioned last week that there was a lot of dealer positioning and things that is usually conducive to a V-shaped sort of recovery because market makers are trapped holding tons of longs when everybody panics and buys a bunch of puts. So the hedging structure and kind of how all that stuff works. I won't bore you to death with that more than you already probably are now, but yeah, I guess you could say, guys, like this is what I think is probably the highest probability pattern here, at least for like the Nasdaq, provided it doesn't make like a new high. If it makes a new high, then it's looking, then it might be something more like the Bitcoin chart. One second, let me pull this up. So something sort of like this, where instead of being a regular flat, it would be more like an irregular flat. So even though, you could still see like a new high, if we haven't really seen it yet, we're really kind of banking on, sorry, jumping around here. We're really kind of banking on this, oops, come on, gains getting together. All right, really kind of banking here that we've sort of hit the high, or at least like this cycle high. I don't know if that's true just quite yet. I think we might have just a little bit more to go. And that's why I wanted to show you this sort of alternative pattern if you zoom in. So from the, just the NASDAQ in general, this looks like a pretty clear ending diagonal to me. Right now we're seeing a lot of, or this last high here, this was like right at this, this longer term sort of fib level. But we did see, a decent rejection with some really high volume, but then we also saw this, kind of buy up before that didn't really look like it got stopped until, like late yesterday. I was surprised to, wake up and see that, futures really hadn't budged much last night. And now that we're seeing, a lot of this like clustering and consolidation, that's where I wanted to show you guys a more detailed sort of view. So if you look at like what had happened today, if you look at some of this volume, like what I was mentioning, earlier in the channels, or earlier like in the discussion channel, is that with this kind of this, it might just look like Greek to you guys, but when you start to see these sort of volume patterns where you see big tests of the low, or not the low, what I mean? Like it's like a price discovery thing. It's like think about it like opposition research, where if you want to sell the market down, you have to figure out how much buy support there is, or how much bulls are willing to pay to defend these levels to keep the market propped up. The dealers are pretty much net short, so they're gonna sell into anything that's like, let's say below 6,000 for the S&P, anything really below like 22,000 for the Nasdaq. But it does have an impact. So you can start to see these bigger sort of like these like red sell spikes. And what these pretty much mean is that there's likely a motivated seller with deep pockets who's either positioning or trying to test what sort of buy support there's going to be if they try to sell it down. And what I mean by that is, so let's say there's a big iceberg order here at this this 21,600 level, and you find out that, okay, well, we spent $10 million to try to sell it down with market sells, and it got bought up right away, and they kind of measure what the bounce response is going to be. It's called like an automatic retracement. And typically what you'll see is if it does bounce strongly like that, then you can get then you just get repeated tests of that to see if they're still willing to defend it with a lot of capital. So that doesn't necessarily mean that the rally might be over. It's just that these are the sort of tea leaves that you look for when you're trying to do just analysis like this, where you also saw something very similar to this yesterday, where going into close here, you saw this pretty decent. Oh, sorry, not going into close, like maybe an hour and a half or two before, you see like this really high volume for about 10-20 minutes, and then you see it kind of dry up, but then you still see these little little red sell spikes everywhere. So this is sort of like a the pattern's getting a little tired. Bulls are they're like, you can still see squeezes and big buy ups and things, but they're coming like few and far between. So the main takeaway here is that there's really like a handful of signals that are kind of pointing towards the rally's getting a little long in the tooth, and there's a little bit of exhaustion out there. And I think most people would agree right now, like a pullback would be healthy. There's really no and sorry, I'll get out of the weeds here with the 1 minute, but I just wanted to show you guys like some of the things that I look for during the day, and try to glue it all together. This I guess to take it up a level, this is like a ending diagonal sort of pattern with a B wave, which is what I think we're doing right now. If this is really the top of a B wave, you might not see this last little leg up. We have hit some pretty key fib levels, things like that, and there is a little bit of room to march up here, but you could definitely tell that a lot of it's been primarily Nasdaq driven. If you look at like if I zoom out, sorry, before I start jumping around again, any questions? Does that make sense to people? Am I talking stupid here? You guys need to help me. All right. You choose your own experience, right? I guess you could say. All right. So if you look at some of these other charts, okay, you can definitely see the same sort of setup, and you do see a lot of these ending diagonals when you get to the end of a C leg. A lot of people get them confused with. So this is kind of what I'm talking about. You can have an impulsive move, and wave 4 into 5 is typically your ending diagonal. But that's usually the C leg in a larger sort of higher level pattern like this. Now, I guess you do see these ending diagonals here at C legs, and you can kind of when you do your measurements and things, you can kind of see that there's some confluence of levels. So those are like things that stick out like a sore thumb. That say, okay, it's probably like price is probably going to stop here and flip around in reverse. But I won't draw those out and things here. I guess what I wanted to focus on is more about what may happen shortly. So we still have this at the hourly level. You can see that there's some bottom wicks here. Bulls are trying to buy it up, but they're just not really getting anywhere. It's getting sold into. You can kind of see these, I guess larger volume. So like yesterday, we didn't have a ton of volume on the way up. It's typically how it goes. But once you started to hit these big levels of resistance, like around these 59, 70 levels, that's where you get a lot of the foot dragging, I guess you could say, a lot of selling that goes into this. Now I do think that the S&P is a little bit weaker. The Dow is definitely not. Sorry, let me pull up my other chart. I got all my stuff. Like for example, the Dow. You can kind of see it's it's got this little target up here, but it hasn't really had enough steam to get up there yet. It still could, and I don't know. I just think it's a little unlikely. You see, there's a decent amount of buy volume here over the last couple of days, but it really hasn't had enough strength to get above this 200 daily moving average. And this red dotted line here is the point of control, which is really just the average volume for buys and sells at this particular level. So it's a fairly important level. You can also see the same sort of setup for small caps, where small caps couldn't even get up to the 61.8% retracement. I think a lot of that has to do with rates. You get a lot of unrealized losses on balance sheets for like regional banks that carry a lot of these government securities. That could have a drag. Maybe they're not being as aggressive with investing or redeploying money, that kind of thing. So that's just a thought there. So for equities, that kind of wraps that up. I guess the other thing I wanted to cover here was more like hedges. So let's talk about. Sorry, let me pull up the daily. It's probably a little easier. And if this is a little confusing, please ask questions. Let me know. So I added this third bull target today. Oh, Susan, you got a question?
Yeah. Hey, Gaines. Could you just go back to the Nasdaq and then show me when you pull out with that B wave, kind of like the how you're tracing that B wave forward, what time period?
Oh, sure.
I kind of sometimes get lost in the waves.
Yeah, no problem. Here, let me. Sorry, I've got like a bunch of charts open. Yeah, that's what happens when you're a nerd. So, okay, so when we were talking about this earlier, with more of like so here's our A wave. Here, let's draw this out. It's probably easier. So in theory,
Got
we'll
it.
just draw this like this, and then I'll try to make it a little bigger for you. So pretty much what we're doing is we're just trying to figure out where this B wave is going to top. Now, I don't really know if it's going to be like a wave 2 or we're going to have like a serious decline. But I mean, this is still looking pretty serious, right? But but I don't think it's going to be like a market meltdown, waterfall. People are jumping out of office windows and stuff like that. But I still do think that there's a decent prospect here for some pullback. At minimum. I mean, these ascending wedge formations here really are really do signal a lot of bearish forecast going forward. So does that make sense to answer your question?
Yeah, absolutely. I sometimes don't have the perspective because I'm looking at your day charts and your hourly charts, and you talk about the B wave, and either I have to go way back in time to figure out where that started, but you're talking about from the April 7th, 8th lows, and then tracing. I see what you're doing now. Okay, that's all I needed.
Yeah, and I'm sorry because sometimes I can get carried away with that too, where I'll say something like, oh, a B wave top, but then it really I'm talking about like a 1 minute kind of time frame, and I always have to kind of stop and back it up and say, oh yeah, okay, like really what I'm talking about is this. So if you guys have any like questions about that, please let me know. I type a lot about B waves.
And again, I'm the novice here, so sometimes I do get really confused about the time frame, but for the most part, I think I can follow a lot of it. So thank you.
Okay, yeah, that's good. And one of the things I'm gonna do more of. So I've added some hedge levels and things on the charts, and I'm happy to go through them like now during the webinars, and kind of explain or answer questions. I'm also going to add some like stop levels. So for future trades, like for example, so let's say we have like the shorts that are open right now that look terrible, but they did have a full hedge up until 2 or 3 weeks ago, but the market hasn't really moved much since then. It's just kind of it's just kind of grinded away. Yeah, I'm upset I had to take a loss about it, but still, like there should be some sort of like trigger for you guys to see on the charts that say, okay, if it's either hedge here or stop out your shorts and flip long or something like that. So I'm going to add that stuff to the charts, especially when I do more, especially if I do more like directional things. So like MSTR for that chart, just as an example. Like I had added in a level, I think it was like right around here, right around like the 340 level, where I said like, okay, if it goes beyond this, it exceeds a fib level, exceeds the prior high, that kind of thing, you might want to hedge with MSTU or something like that. So that's just one of those things that I'm trying to get better at. So if there are no like clear sort of like trade paths, or if then please let me know. Okay, so with that being said, in general, what I'm thinking is probably a good thing for you guys to at least be aware of is like when I put these hedge levels on the chart, really what I'm trying to do is at this point we're just trying to protect against runaway upside. Alex thinks that we're going to have a new all-time high. I don't think that that's going to happen this time. I think that if we have let's say we have like a couple % dip and then bounces back up, then yes, there's definitely a case for that. But I'm not seeing it right now. There's just not enough like bullish energy to carry it past that finish line unless there's some sort of major catalyst like all tariffs canceled for forever and White House cures cancer overnight or something like that, which I wouldn't expect anything less. But anyways, like with that, if that happens, sure. I mean, those are those sort of like unexpected drivers of price. But if you guys do remember, the last the two things that have kind of really, surprised us. I mean, just a lot of analysts in general. I think people that were long right around here pretty much got lucky. And I'm not just saying that because I got burned, but like usually the 200 daily moving average is a battleground for like at least a couple days. And we did see that back, for a couple days before then. But then we also saw this gap up, and I think it was during the hour where futures weren't traded. So the 23 hours a day where futures are traded, to make a move like that when to gap up above resistance is one of those things where it's kind of like, all right, it's kind of cheap. You get mad about it. So like even if you do set stops and you do the right things, you can still get burned sometimes. But long story short of it is that the 200 daily moving average, it doesn't really just get ignored like that. It's really a magnet for price action, and the fact that we've been above it, I kind of think about it. And Mark, I saw you join the call too. It kind of reminds me of like a longer term VWAP almost, where it's got that magnet effect with volume and trading, especially if we're like, really, really close to it. So we see in the last, couple of weeks, really, this sort of area above and below has been a big driver of, not a big driver, but it's been like a, kind of like a battleground almost, but, we've been trading above it now, and now we're starting to see some weakness creep in, where I think that we can expect at least a visit to, something like, 20,000, where that, it'll test that 200 daily moving average support, plus also the 50, and, so on and so forth. So the hedges here, they kind of, come full circle. We're really just trying to protect against further upside. Now, I don't know if I have this at hedge long 1-to-1. I don't know if that's probably, I don't really know if that's a good idea. I think it's more like a 50% sort of thing. So if I had to, I probably would have changed that before the call. So I'll make a quick edit here right now. So the idea here, I think I typed this out the other day, where is, so if we just make a, just a quick little high, and then pull back down, you don't want to be stuck hedge 1-to-1, because, you might not get a chance to, get out of it again. But if you were to hedge 50%, so let's say, price did something like this, where it just makes a slight new high and then, heads back down in this. I mean, you'd probably be furious, right? I mean, I would be. So, but it's happened, and it, probably won't be, the first time or the last time, et cetera. But what we're trying to do here is protect against upside. If you can't really suffer through any more like drawdown, I mean, well, what's funny about hedging is like every time you think it's about to pivot, you try to do, you try to like release those hedges. And if you would have carried them from the bottom, yeah, coulda, woulda, shoulda, right? Like almost nobody does that. You probably would have taken profits already, or at least 95% of people would have taken profits on hedges already. So now we're kind of in that chase mode, where that can drive a lot of this type of buying that we're seeing, which is this, it just kind of seems like there's no end. But bulls understand that psychology, and they press the advantage by trying to, keep buying up the market. So you feel like you got to chase and hedge, and, that kind of adds more, buying to the mix. So with that being said, you're just trying to protect against new highs. Like for example, if it's overnight or something, you get a hedge order triggered. Like you typically want to set like the other 50% above like the last, or, not above, but slightly above like the next major fib level in your drawings. And for the Nasdaq, that would be the last one here, which is this 0.941. It's kind of a lesser known level, but the reason it's significant is because that's typically where you'll see a pivot if there is like a flat corrective pattern. So now that we're getting kind of close to that, it's just something to be aware of. So that's why I'm thinking it's probably a better idea, instead of hedging like 1-to-1, you still want to protect a little bit against that upside. And then if you do get up here or if we do get up to this next level right around this 21,890, and it does reverse, you can at least set like a break-even order or something like that to get out of those hedges. Or if it keeps moving up and this level of resistance doesn't really work anymore, then you add the extra, and you're only you still kind of have a couple points there that you had to lose, but essentially you're trying to stack the probabilities in your favor. So you're trying to trade it smart still, but you still have this potential for upside. There's also the other approach, which is add a long hedge on a pullback. So for example, if we were looking at this sort of pattern, so this one kind of became a little bit more clear last Friday, and I was kind of thinking, okay, well, we did have a bit of a low, but then we had that buy up like into close, so we had a bit of that Friday or typical Friday short squeeze. That to me, that was kind of like a signal where like, okay, maybe like a 50% hedge or something would have been appropriate to close out and not be like 100% net short over the over the weekend. Typically, bulls don't like to be long over the weekend. Vice versa. So with bears this time though, we did have a little bit of a retracement back down in the morning on Monday, but then it was ultimately bought up again. I remember kind of watching this on Monday, and there just wasn't a lot of strength there. It just kind of reminded me of like, okay, there is selling that's going into this, but there's not a lot of there's not a lot of gas behind it. So it kind of just it's more like a position adjustment rather than like somebody's trying to move the market, if that makes sense. So anyways, you could have done 50% here, or just held it as it creeped up higher, and you could set a break even stop order or something like that, or you could continue to move it up. But hopefully it makes sense. Like there's a couple different options that you have. So once the pattern becomes a little bit more clear, like again, I do expect this to kind of happen, but I've seen it before where you get these like these B waves longer term, or like a wave 2, where everybody expects it to hit that last little high, and then it never gets there. It's 50 points short or something like that. And from what I've been seeing today, with again with this price action, with a lot of these sell spikes and things coming through, it just kind of seems like general weakness to me. So if we do see like one of these sort of smaller B waves, like this sort of scenario, let's say it heads back down to like 21,500, and then you kind of see the same price action like what happened on Monday, where it's just not a lot of buying into it, or really selling either. That's I think where I'd probably add like a 50% hedge, and then you could probably wait out this last little leg up. But yeah, so once that finishes, that's kind of like the bullish scenario. If it does get up here, I would sell out of any longs that I had. I mean, I've already done that, but at least for like a methodology to trade it would just be to once you get to the top of the pattern, if you have the capital to do so and you don't mind waiting a day or two, once it hits the top of the pattern, typically you'll see not just like a full retracement of the entire pattern. If it was to be like a wave 4 and a 5 kind of thing, like these are the sort of inflection points that we're looking for once we do get some selling. And I'll put those levels on the chart. But for now, I guess oh, hey, here we go. I do have a little bit of a flat chart. So here's what I was talking about, Susan, for your question, when I was saying that these B waves, these longer term B waves in a flat pattern can typically retrace up to about 90-95% of the entire prior range. Now, it's not very obvious, when you're halfway through that we're going to see a flat, that kind of thing. It's just a very difficult, corrective patterns are very difficult to trade. The first leg down is always the most difficult, but then where the retracement stops for the second wave or the B wave, that's also equally as difficult. Now, if we do see some sort of, pullback here, I do expect there to be, something like this to kind of confirm that pattern where you do see that 5 wave down. So I know I've been talking for a while, and I'm going to open it up to some questions, but from an equity perspective, I'm thinking we're getting really close, if that makes sense. Now that the pattern's kind of have been developing recently, and you're starting to see some, atrophy of some buying or just weird behavior. That's, typical of people are starting to get antsy for some action. You're starting to see some sells or, things like that. But for the most part, I think equities, they need a break coming up soon. You can also see like some of the red line down here. This is RSI. You can see it's, we've got some overbought. Sorry, there's some money flow. You can see we got some overbought, situations going on here. Last time we had overbought, we had a 2.5% pullback. So it's just been kind of like bumping up against that, and at the hourly level, that's that kind of says something. Okay, any questions about equities?
Yeah, I have a question, Gaines.
Yes.
Yeah, on the hedging, I'm trying to learn more about this because what I tend to do is when I hedge, then I end up hanging on to the hedge too long, and it goes in the red, and it's all messed up. So I was just wondering, like if you hedge and then it goes against you, do you get out of that hedge right away, or do you hold on to it and hopes it'll go back?
Oh, that's a great question. I would say it depends on where the chart is, or like where the price is trading out of the chart. So for example, let's just use, price action today. So let's say that as of today, right now, this is like our B wave top for this small little B. So if you hedged long, let's say, and then it kind of, went against you tomorrow, the point being that, having like a 50% long hedge, the tactic would be, okay, so, let's say it gets triggered and then it dips back down. And then you can see like, okay, maybe there's a floor or like a Friday or something like that. You see there's a short squeeze or whatever. Like right here would be where you would want to add that other 50% to get out of it. And if we have just even a 50% retrace, then you could get out of both those trades at break even, and still recoup some of that, short drawdown that you had. Now that's easier said than done, of course. You have to be very kind of crafty with your exits and timing, but it can be done, especially if you have, time to watch it throughout the day. But like, for example, if we were down a little bit lower, let's say, we had this little kind of, corrective move over here, but there just wasn't a ton of volume with it. And, you hedged and you kind of held on to it for a while, but then kind of got faked out right around here. And sure, like maybe you made a couple of bucks, but then you kind of, let's say you started to see it go back up again and you wanted to hedge. That's one of those things where it depends on where the pattern is, where you want to exit that sort of hedge. Typically, if you see some consolidation, like I think we were talking about this, looks like a, rounded top and like a cup and handle pattern. And then I just think to remember adding that I've been fooled by these before and it'll probably go higher. And it sure did. But again, like with those sort of hedges, like it gets really, really dicey and kind of weird when you're trying to figure out where to hedge, especially if a pattern has kind of extended itself. So I guess, the 50% method I like a lot, just because you can always add more later, especially if you're not like at your wit's end with, carrying losses, that kind of thing. So, if you kind of stagger those hedges, then at least gives you some sort of breathing room where if you do see a small pullback, let's say for the night or something, you still have some protection on it. Ideally you've been feathering in hedges, or not hedges, but like feathering in shorts as it climbs and, that kind of thing, or like as it declines, adding in some longs. But on average, if you're doing hedges right, you should at least have some sort of short, some sort of long position to kind of balance it out. You can have a net bias, like a net long bias, and net short bias. But another thing you can do, let's say, if your hedge kind of goes against you, just wait a day or two. The market typically gives second chances or even third chances to exit a unprofitable position. So you could see, let's say selling in the morning, and then buying in the afternoon, and then before you know it, I mean, how many times have you entered a position in the morning only to like short the bottom or long the top kind of thing, and then you're kind of stuck. But maybe in like 2 days, you might get a pullback like this, right? So like if you went short, and you just, you picked the exact wrong time and then you kind of hedged it right away. Having that real tight sort of negative spread delta is going to be a lot easier to exit both of those trades versus like letting it just be a huge sort of negative delta. That I think is probably the big takeaway. And I know it's a little bit of a long-winded answer, but I think it's still a really good question. So I wanted to try to explain it a little bit more, where there's different like strategies depending on where the price is at and the different charts. But for the most part, you can exit as long as that spread is pretty tight. You might not have that ability to do that. Like for example, like the oil trade for the TGPF portfolio, the longs are underwater, but not too bad. And the shorts, so it's about like an $8.5 grand sort of delta there. It's a little bit wider than I would have liked, but you never know what's going to happen tomorrow. You can only guess. And I would say good practice is typically to throw at least a little bit of a hedge on it, and just kind of let it roll, because odds are you're going to see the price again in the next couple of days, and you'll have more price action to read, more charts, and you can kind of discern whether it's a good idea to maybe add to the hedges again once we get the the level you want, or if it goes lower, add more, that kind of thing. It's really just kind of depending on where stuff is at. So hopefully that makes sense. But really there's I'd say 3 really solid strategies that they all work. It just depends on where what the chart is kind of doing, where you would want to implement one or the other. And that's a great question for discussion too, if you want to bring it up. And that's just something where I think everybody would benefit, because they're all probably having the same questions. So hopefully that helps. Any other questions about equities? Or yeah, no problem. Okay. All right. I'll just cover the yield quick and some of the other guys. So the yield today was a bit of a surprise. I still think that it's not in the danger zone yet of kicking TMB's butt. However, this does kind of look like a flag, and sort of like a normal retracement. Plus, also you might get some. You're probably getting some people buying the dips with bonds, which is probably why you're seeing a bit of a downdraft here. But and it might continue. So for example, it looks like a flag now, but it might not be tomorrow or Friday, right? So if we get bad unemployment data, and then let's say we get bad payroll data, the yields will probably fall. But again, it's still kind of it's probably just a smaller pullback versus something like if they pass the budget bill sort of thing, and that adds a ton of the debt, then that should shoot the rates up. But there needs to be a catalyst there to move the bond market, because it's pretty big. Tim, you had a question here. It says, how do you tell the difference between a small pullback and a larger one? Yeah, that's a good question. It's a little difficult to tell on where it's going to stop, but usually you can tell if it's the beginning of a larger one, just by I wouldn't say the strength of a retrace. It's more of the total volume that you see. So for example, to kind of go back to what we were talking about before. So I got pretty excited last Thursday because we're seeing this sort of shooting star kind of candle here, where bulls tried to jam it up again and it just got shut down. And by having the slow, steady couple day staircase climb back up, it's not unexpected. It's just a retrace. I mean, if it makes it too high, okay, well then the ending diagonal pretty much plays itself out. But to kind of put that all together with what's a longer term versus a shorter term pullback, a shorter term pullback is going to be depending on a wave structure. So if you look at something like this, where you see this A to B, you can kind of assume that this is going to be just a short-term pullback because, we had the essentially like the cancel of tariffs, right? Everybody buy, that kind of thing. And then you had this like flag that that kind of like walked itself back down, and that's the bears trying to get out of their original positions. It's really just like covering. So like a short-term sort of decline is usually something that follows after like a big move up, because it's just institutions adjusting large positions, and that's at least I guess at least a something to keep in mind. But once that's once it kind of bottoms and you start to see more bullish activity like kicking it up, then it's like a signal to kind of either get out of shorts or it's time to hedge up or something like that. But once you start to see some volume pick up, that's where you might notice like a bigger decline. So the if you kind of look back here, we did see a couple steady days here where volume was declining. This is where the bears still want to get out of positions, but they also don't want to crash the market even more, for a number of reasons, right? But now that we're starting to see the volume increase here, it's just kind of like the shot across the bow, right? It's like the cannon heard in the distance, where it's like, okay, we've got some decent sellers up here, so now maybe let's be a little bit more careful about trying to do short squeezes. So this you see higher volume once it kind of precedes like a larger move. So I mean again, we could still chop up here for another week or two, that kind of thing in this sort of range. Excuse me. I've seen that before. We could keep, stay up here for a whole month, but the longer it stays up here, the stronger the corresponding move is going to be to the downside, I believe. But yeah, so hopefully that answers your question with that. All right, let's just do gold real quick here. 1 second. Let me pull up my other chart. Is this helpful? Hopefully answering some questions. I'll assume so. All right, so gold. Gold here has, it's been a little weird the last couple of days, but I think it's just a normal sort of back test for this breakout. I think that 53.13 is a reasonable extension level for gold. It's not quite a new high. So we could see some sort of like a similar pattern, like a flat that where like this level here, this A equals C being at this 35.13. Again, not a new high, but about 90-ish, 95% of a retrace. So then if it does get up there, we could see maybe a wave 4 in gold like this, or sorry, like a completion of a wave 4, and then maybe into maybe like fall or fall or winter, that kind of thing. You see like another higher high like this bear target 2. Sorry, bull target 2. Who wrote that? Fired. There you go. All right. Silver is looking really good. If you trade futures, this is a pretty solid, pretty solid indicator here of a, like a bull pennant. It could extend a little bit higher. I think it will. I think 36 is reasonable. So if you're trading futures with it, you could add along, because I think this triangle is almost about done here. You could add along and then set a stop like right below the lowest flag low here. So like a 34.15. Okay, any questions on like metals? If not, I'll just switch to oil quick here. All right. Sorry, this chart looks like a bit of a mess. There's a lot of stuff on it. I'll try to clean it up. But I'm kind of thinking what we're seeing here is just a normal sort of consolidation. There's a lot of selling that happened right at this trend line, and it's okay. Like, the fund is hedged 1-to-1, but I just wish it would break one way or the other. I would like it to break up so we can get out of the longs, because I think if the economy is going to slow down here, oil prices and things like that, there's just less demand in general. So on and so forth. It's probably going to be easier to get out of shorts than it would be for longs. So that's some of the thinking there. Hopefully, get some sort of traction above this level throughout June here. If not, and it stays range bound, well, we have shorts, and the next target to exit would be right around here, like the 55 level. If this does end up being like a giant wave for a larger pattern, which it might do that, then likely this 53.20 is probably the floor if we are going to see a bearish move here for oil. For gas is starting to get a little bit finicky again after some reasonably predictable last couple of weeks here. I think this also kind of looks like silver, right? It kind of looks like this little consolidation cluster, but more of like a continuation pattern here. I really would like my target to exit Boyle is, if we do get up here to, this 4.076 level, because that would be a fair place to exit as like an A equals C. And then, now that like seasonality for the year is kind of wrapping up from a bullish perspective for gas, I would want to try to exit Boyle. I think it's in profit now. I have to check, but I think what I'm going to do is probably just set a stop loss for it and at like break even or something. So then if there's an issue where let's say the contract adjustment we had the other day, that kind of screwed everything up. That kind of wiped out some of those the most of the profit for the Boyle position. But if we do see a move back up here to like even this 786 level, then that position should be back pretty much where it was before. Any other questions about metal, gas, energy? All right, so stocks here. This is an interesting one. I think that this 219.14 level is going to be hit no matter what. There's a lot of volume picking up, so that's why I'm kind of thinking here that things are about done. Because now it looks like a wave 4 in a larger sort of sea leg kind of pattern here. I wouldn't hold longs any more than up at this 219 level. Plus, it's also been kind of like button up against this 200 daily moving average, and you kind of see the constant selling underneath. So I think that there's general weakness there, but not enough short accumulation or distribution yet from bulls to truly like offload it yet. I think that'll all ships rise and fall at the tide. So you'll see stocks decline at the same time as you see Nasdaq and all those other mega caps and stuff. But long story short here, I think that we got probably another leg to go here, but that does set it up. If we don't have some sort of mega huge correction, takes everybody by surprise again. If we don't have something like that, it does kind of set it up as a bull flag. And if you're still bullish on like the AI trade and some of the other big names like Nvidia, that kind of thing, you might have prices on sale soon. I mean, this would be nice because I would like to add some Soxel and some other longs. For the record, I hate being short. I hate it. It sucks. It's so much easier to just be long and hold the longs and then hedge the longs than it is to be short and have to hedge the shorts. It's just there's so much more time that markets spend being bullish in like retracing versus being short. So that being said, I'm still trying to exit some positions there and reposition to be bullish, but I still need to see some sort of continuation. I got to see some lower lows, and I just don't think it's a good. I just think things are a little overvalued for where we're seeing the general economy perform at the moment. Bitcoin here is the last one, I'll show you Tesla here. This kind of looks like a head and shoulders pattern here, but I do expect it to head a little bit higher up to this 114 level. It's really a stone's throw away when you're thinking about this entire pattern. It's already made a new high. I just think this is more like a profit taking sort of distribution sort of thing. I think Ben made a comment in the Inner Circle channel yesterday about just in general, BlackRock moving some Bitcoin. I think it's sort of a move to sell. You can kind of see like a lot of this sort of clustering here for selling. But the next step, if this, because it kind of does look like an irregular, the max for an irregular in this sort of situation would be like around 123,000. Because typically you see a B wave stop if it's irregular at its maximum at 1.382. If it exceeds that, then it becomes a wave 3, and then you better get long or get gone. So I just came up with that. Hopefully it sticks. Oh man, laughing at my own jokes again. All right. So let me show you real quick here. I don't know if you guys are laughing at me behind the scenes or, whatever. Have fun with it. All right, let's just show you MSTR real quick. So I think that this one is just a little B wave here, and this might coincide with that run up with Bitcoin if it does head up to that 117, like I mentioned before. It could even head a little bit higher. That's why I'm trying to keep this trend line in here. As of right now, this is a major level kind of hit up against, but if you do see like a higher sort of retracement here, this might actually turn into a 5 wave down like this, but I don't think it will because the higher level pattern is ABC. So this, I guess it's semantics at this point, but the long story short is that we're really looking for this sort of area to be the like the rejection zone, or like the sell zone, I guess you could say, or whatever you want to call it. If you wanted to try to play it where let's say you want to hedge and like protect some of the recovery profits for SMST, what you could do is you could set like a limit order or something, stop limit order on like MSTU or something for a long hedge, or sorry, to hedge the shorts, you know what I mean? And you could, and if it does keep moving down, you can just keep setting it lower. But the only thing I would caution is to make sure it's not super close, because the daily kind of price action is gonna kind of gyrate around throughout the day, and you don't want to like accidentally trigger because you're busy watering the plants or something like that. So it's just something to be aware of. Like you can play that strategy, and it could be a profitable strategy, because if it you get something like this, and I may actually do this as well with the fund, but I got to drum up some more cash first. You might be able to play this sort of move where you might be able to make, if you had a $10,000 position, you might be able to make $1,500 or $2,000 off of a move like this at a small little C leg. Okay, I got a question. Hopefully you guys can't hear this rabid dog barking in the back. Okay, yeah, no problem. Thank you, Mr. Nelson, sir. Okay, real quick here, kind of wrap up. So Tesla's looking like it's a little tired. You got a head and shoulders here, and this is a bearish sort of setup here where Tesla couldn't really get above or reclaim its broken trend line today, and that's good if you're short Tesla. I mean, in the fund I got TSLQ. I don't think it's too bad. It might actually be profitable today. I'm not sure. I have to look. It's been busy. But the long story short here is, I'll be adding some bear targets tomorrow to the chart. I just wanted to see if it would reject or not. And at this time, I think it has. So I think the next stop is right around like this 310 level. That would be nice. And then, could extend even lower to start testing like the 300s again. But it kind of depends on, if the Nasdaq actually starts to dump, or other like mega cap stocks do as well. Because you're not really going to see one stock sell off 20% and then the others sell off like 2. It just usually it's all or nothing. Okay, so then NVIDIA real quick. NVIDIA's got this ending diagonal thing going on here, and the unloved fib level, this 0.886, that's where I kind of expected to stop. So that 146 level. I still think that there's a lot of hold on, if I zoom out, there's a lot of this high sell delta here between this range, between this point of control. Oops. Well, that's the next highest level. It's called the volume profile of a B. So it's like you have this zone here as good resistance, and then you have this zone here is also where probably a lot of shorts are trapped. So I would expect this to hit like this 146 level and then drop down to about like the 120s again. And that would probably pick up a lot of buyers, but If it does something like this, you might only see like a very, very short sort of drop, because you might see you will see it, especially with NVIDIA, because popular stock, it's strong, it's got a lot of participation. You see this, if you do see a drop like this to, test these moving averages again, you'll see some sort of pop up like this, and then that might be a good spot to short. But I don't know, shorting mega caps is kind of a fool's errand at times. And then real quick, the last one here is Palantir. I've got a small short on it. It doesn't have any leverage or anything, but this one's kind of looking old and tired too. I'd say 139 is probably the max it would go without any sort of flip bearish. Okay, so last thing just kind of popped in my mind here. You guys had some questions about VIX and the UVIX positions. So there is this sort of like support level here. It's easier to draw a trend line. You do see some sort of like a support level here. Let's say you do see that last little push up in equities like Nasdaq. You might get a little bit of a dip again to maybe like 17, 26, but we're not talking like 12 or 14s, I just don't think that that's going to be realistic. I think that there's enough damage that has been done from tariffs and a lot of uncertainty now, where people are going to just continue to hold protection on their portfolios. And that's kind of what, it's the majority of what drives VIX. So people just, holding puts, like if we have a reasonably high put to call, ratio, that kind of thing, it's going to keep VIX elevated. So from the UVIX trade perspective, I think it's a good entry. And, you guys are right. Like even if the VIX moves only, you've seen it before where, it moves 10% a day, right? So 10% a day is 2 points on that thing. And it's, UVIX is going to be up 4 because it's a 2x leverage. So that might be a nice kind of layup trade there. What you could also do if you don't really want to mess with the volatility, I'm not sure if Neil is still on, but if you don't want to really mess with the volatility there, or like the daily compounding, you could probably take like a call spread or something like that on something like UVIX. The options get a little weird on a leveraged instrument, but the impact is still the same. Like you still want to protect yourself, but at the same time, it's a spread, so you have limited loss, and you don't tie up as much capital, but you can still capitalize on the upside. All right, that's. I know I talked a lot. All right, what do we got here? So Susan, yes.
Yeah, just to expand on that comment, the options get a little weird on leveraged instruments.
Yeah, so what I mean by that is, the daily compounding, it can, like, if you have options and they're, of course they're all valued with the same sort of like, Black-Scholes methodology, but you have a little bit more risk if, okay, let's put it this way. If you were entering an options trade for, let me draw it out. So if you're entering an options trade, let's say like, I don't know, like right here at this, like, let's just say like 20, keep it simple. So let's say you enter here, and then, that daily compounding of, UVIX or whatever, that's gonna decrease the value of your option faster than something like a 1-to-1 no leverage sort of spread. So if the price moves down here for VIX, your actual options value is probably going to be more likely, I'd say like 20-30% lower than what it would be if you just had an option on like an option spread on something like a non-leveraged volatility instrument. So something like that. But then if it does head back up here, what was that? Like if it does head back up, you might not profit as much, but it depends on where you enter it. So if you enter it like right in the middle of a pattern, and let's say you just haven't been patient and you want to try to trade volatility, you think something's going to happen tomorrow, like you're trying to play earnings or something, you're going to have a lot less sensitivity to that if you enter, let's say like around here, where if it kind of goes like this and you hold and don't close and it kind of does this, well, then you'll be able to that daily compounding risk is going to be negligible when it comes to, the prospective upside return on something like that. So again, like it kind of just depends on where you enter in the chart. So if you're in at support and you take a bull call spread and you've waited long enough to get that good entry, then you're not going to really have a lot of that weirdness or risk versus something where it's just like right in the middle of the pattern. Does that make sense?
Yeah, I think so. I mean, options on leveraged instruments is pretty much like spending the afternoon in Vegas. To me, So it's not likely that I'll do too many of them, but I just wanted to hear what your thought was about why it wouldn't necessarily capture the same amount as a non-leveraged instrument. But you're talking about the price action being so quick that you may not be able to capture it. Is that kind of how I should understand that?
Well, I would say the volatility risk with the options and the daily compounding is really more, it's more prominent when you're in the middle of a pattern, when you're not at like support. So to kind of summarize, like where we're at right now with the VIX is about as low or slightly above as low as I would say anybody's really expecting it to get right now. So you could buy the shares, but if you're concerned about the compounding risk, I really wouldn't be, because like it's it's kind of like the risk reward of like going long right now, where if you're adding $100,000 worth of longs in like Nasdaq, I mean your risk reward is a lot of high risk but not a lot of reward, versus if you enter like a volatility instrument here where volatility is really low. Volatility always comes in cycles. So, I mean, even if you get a 10% bump and like a 2 or 3% pullback, that will still be a profitable trade.
So how about thinking about, and again, I'm not going to do this, but I'm just thinking about like what you said with the options on these leveraged instruments. So the VIX is pretty much, at the low that we think it's going to be. And you've got a leveraged UVIX. So if you were to like say, buy calls 1 month out at a delta of 0.85 or 0.8. So you're kind of like buying a call where you've already kind of got, I think, a lot of the intrinsic value and you're just looking for a little pop. Is that like, I mean, the VIX is not likely to stay completely at this low level for the next month. So is that really all that risky in terms of risk reward, assuming I'm not, buying 3 million of these things?
No, that's actually, so I'm glad you brought that up, because a really easy way to kind of estimate your probability of profit is going to be your delta. So if you and that's why it costs a lot more. So if you buy an option with a delta of 0.8, that's like strong, like you're probably buying in the money down a couple points. So the probability of you ending in profit is very high, 80%, right?
Exactly.
Yeah.
Exactly. So if you have two things here, one is the probability of ending in profit, but an underlying instrument where it's very unlikely to stay at that same level or even go lower, that significantly lower over the next month. Is that a pretty high reward versus risk? Yeah.
I'd say so. The only factor that's gonna complicate things is if you don't give yourself enough time. So kind of like I mentioned before, like topping, it's a process. It takes it could take a couple weeks. It could take a month. I mean, think about fall, right? It's like 3 months worth of topping and the same sort of chop crap that we had. If that's the thing, then there's not going to be a lot of movement there with volatility. It's just going to be a snooze fest. And if you buy that 80 or that 0.8 delta call, that's an expensive call, and it could kind of like it could kind of devalue faster than you would expect. Like let's say you bought like a 30-day call. So what I always kind of think about is like, okay, so it's a good setup, right? But if we chose 30 days, you're kind of rolling the dice that something happens within 30 days. But as we kind of talked about, there's macroeconomic things coming up, like likely there's a budget that's going to be passed, that's going to be, that's going to add to the debt. So that'll probably cause some volatility maybe towards the end of July. So like a 60-day horizon might be good. Or if you're not really expecting much, maybe something like a 90-day horizon gives you enough time, but you also sacrifice a little bit of that profit because, even though your delta is high, your rate of change for each dollar that it moves isn't gonna give you as much return as something that, let's say, you only had like 30 days on. So it's more of like whatever time horizon you're more comfortable with. The longer time horizon, it's going to be a little bit more expensive, but it gives you more time to be right, as opposed to hopefully you're right and you got your timing right, and you get a lot more profit for that. I guess my experience with this is I've been in this sort of conundrum before, where it's like, how do you kind of thread the needle for like a time frame? I like, if you play earnings, something like that, like the Fed does their announcements, about rate changes and stuff, like, choose dates after that kind of thing, or like do it beforehand. Like, try not to give yourself more complexity with the trade that might impede any sort of potential profits. But I guess you would say, like, to kind of sum it all up, it's really just kind of depends on the current climate, and what we kind of expect over the next month. I would say, like, you could probably buy two 90-day calls or something like that, versus like one slightly cheaper 30-day call with the same delta. That's something you could probably use too, but it's just a little bit more of like an upfront sort of investment, like an upfront debit. But at the same time, you also know what your all-in cost is going to be with that. So hopefully that kind of gets those gears turning there.
Yeah, and again, I don't want to argue too much. What I'm kind of looking at more is, look, we're at almost a floor for the VIX, maybe. And it's unlikely not to have some spikes over the next month, even if the market goes sideways, kind of. Mm-hmm. And so, I guess, if you're agile, I'm not going to do it, but if you're agile and you want to like leverage that a little bit more, and maybe there's no reason to do that, that might be one kind of way to approach it. But I get, these calls, you buy a call a month out, you're just fighting time with anything. But like I said, the VIX is low. It's not likely to go significantly lower unless perhaps all tariffs are canceled, or some silly, kind of news event. But it's more likely to fluctuate during the month of June, even if the market even if the market goes up, it's more likely to fluctuate. So that's all I was thinking. Okay.
Yeah. And the only other thing I'd say about it too, for anybody else who's listening and considering something like this, in the event that, let's say, we do make a new high, like an all-time high kind of thing, the VIX will probably dip, but at the same time, you're still going to get people that are going to hold that protection. So, kind of just talking about this, that's like 17 level. We went through this a while back where, it just, like, VIX just didn't really decline, past like expectations. We had this very, very low floor, like back in December, and then we had a whole bunch of these little pops, and these are a lot. If you have UVIX, like, I would say typically it's easier to short volatility than it is to go long volatility. But if you do have the time and the capital and you don't really have a lot allocated, it could be a nice trade, especially if you have the right entry points for it. But yeah, I'd say, like, if we do see an all-time high kind of thing, like, you can always add a hedge to it. Like you could always sell a call or something, and you just have to buy it back once looks like we're topping out. But again, like, it does take time to top out. So if you only have 30 days, you might be sweating that one a bit.
Sure.
Would be.
Yeah. Thanks. I'm not likely to do it, but thank you.
Yeah, I mean, it's still good questions, because I mean, a lot of people have different strategies they like to execute. Some people like to play earnings. Some people like to do volatility. I like to kind of dabble in a lot of things. But yeah, it's a good concept to cover for sure. Okay. Any other questions, comments, concerns? I know we're kind of going a little long today, but that's okay. I mean, doesn't bother me. It's what I do for a living. So, so yeah. Any other questions, comments, concerns, or we can wrap up today. What's that? Gains get better jokes for next week? Yeah, got it. It's on my list right here. Okay, guys. Well, thanks for joining, everybody. I appreciate it. Hopefully, we get some good news, and for those who are big short, big massive short, I think that we're getting pretty close, and I think that it just requires a little bit more patience here. Again, the strategy is to just manage that upside, and there's really nothing you can do except for just try to be smart about it and not like over trade hedges and things like that, because there will be better entries soon. And if equities are making you mad, try looking at some metals. Try looking at some energy trades, or some sectors, things like that, because there's always good chart setups and stuff like that. And if you identify something, throw it into discussion. Happy to take a look and partner up on it. All right, guys. Stay happy. Stay solvent. That could be difficult. All right, guys. We will see you later.